Hi everyone. In this episode, we'll be talking about whether house prices in Australia will continue to rise this year and into next year, or whether you should probably wait because all the data is looking like they will slow down. So I'll be sharing with you 5 or 6 key charts. As you can see, there's already one in front of you that I'll be going through, and that will allow you to more quantitatively make up your own mind whether prices will continue to start increasing, or continue to increase at a fast rate, or whether they will slow down. So if you're kind of still thinking about whether you should buy property or not, whether it's to live in or invest, this next 10 minutes will be super, super valuable. And at the end, I'll give you my take, a synthesis of what I think will happen based on the preceding 5 or 6 statistical charts. Okay, so my name's PK, and I help hundreds of people build passive income through property investing without dropping $15,000 on a buyer's agent every time, using data. And this channel exists to help you guys get ahead through Australian real estate. I'm grateful for each and every one of you who listen, who watch, who tune into these episodes, for being part of this community. If you like what you see, hit the subscribe button, turn the notification bell on. If you really enjoy what you see here or what you've experienced before here on this channel, give it a thumbs up, and that way, it goes to more and more people. All right, guys, and as I go along, I really want you to tell me whether you agree or disagree. I'm interpreting these charts. I'm just one person. Everyone has a right to interpret them. So the first one, let's get into it. So really, what this shows is the monthly change in national dwelling values. So just to give you some context, here we start in August 2012, and here we are in August 2021. So it's August every year for the last about 10 years. And what you've really seen is that, this is monthly change. So basically, the majority of the last 10 years on a monthly basis, prices have risen. They've been above 0% growth. In other words, they've been rising every month. Really, the call out on this chart is to beg the question, when will APRA, or the Australian Prudential Regulatory Authority, come in and say, enough's enough, everyone's had a great time, we're now going to stop these price rises in property, we're going to limit how the banks can give loans to investors. All right, and so they've done this before, and this is what I wanted to call out. These charts are from CoreLogic. So the first time, the last decade, APRA did this, they said that, okay, the first round of macroprudential regulation, they said, well, dear bank, we want to say to you that only 10% of growth can occur on investment lending. So if you've lent to 100 investors last month, this month you can only lend to 110. Obviously it's not customer by customer, it's based on values, but just to give you an example. And so that was one method. They said, okay, we'll use this to cap how much investor lending can occur, because right in this time period, 2014-15, there was like a boom going on around Australia. And what that's meant, as you can see, is that prices actually didn't stop. They didn't start falling immediately. They continued to rise for about another 6 months to a year, and then that price rise dropped. So don't confuse this decrease here with price reduction. That's not what it is. It's just the rate of growth is reduced. There's only a smidgen of time here where prices have actually dropped month on month. And so they started going up again, right? Even despite this regulation, they started going up again. And so then there was a second round. APRA came in and said, all right, guys, that didn't really work. And what we're going to say now is that regardless of growth in investment lending, you can only lend to investors as 30% of your total investment lending. Obviously, the balance is to upgraders or owner-occupiers, first-home buyers. That had a more immediate impact. And once again, you can see that it's not like prices dropped. This level of growth stopped increasing. It mellowed out. And then there was a period here after the Royal Commission, the Banking Commission that you might remember. That's really when the sentiment was taken out of the market. So what I can deduce from this, and tell me in the comments whether you agree or disagree what your thoughts are, is that APRA coming in and trying to cool the property market hasn't really worked as well as people think that it has. Right here after the first step, it didn't really go backwards. That was a tiny smidgen, more just the rate of growth stopped. And in the second event, similar thing, the rate of growth stopped. Really, it was the Royal Commission that, really meant that prices dropped, up to about 7 or 8% in total, I think it was. And then you can see, despite all that, there's mountains ahead. So the takeaway from this is that even if APRA comes in, prices aren't going to drop anytime soon. It's just the rate of growth may drop. And even that will take 2 or 3 years to occur, as we can see from history. So, if you're sitting on the sidelines, don't fret. Even if APRA comes in, and they've said that their job isn't to regulate the property market, their job is to regulate the sustainability of lending, right? Their job is to regulate whether people can actually pay back loans and therefore our banking system remains healthy, not to reduce property prices. So even if they come in with a heavy hand, it will have a very delayed reaction. So guys, that's the first chart. If you're getting value, please subscribe, and we'll go through more episodes and videos like this. But the second chart I want to show is, this previous one was national dwelling values. I want to just demonstrate that Sydney dwelling values had a higher beta, or had a higher volatility. So you can see this here, between 2014-15, this growth was about 1.5% nationally. In Sydney, it was up at 3%. Nationally, the bottom was about 0.5% negative. In Sydney, it was -1%, etc., etc. If I just snap back to this original chart, to the new chart, original chart, new chart, you can see the highs and lows of Sydney are more pronounced. What that tells me is that the average is averaged out by both Sydney and Melbourne being at a very high and low, kind of, very volatile markets, whereas there are actually some markets, even after the Royal Commission, even after the second round of macroprudential regulation, in Australia, they actually continue to grow. So like if you bought in Geelong in 2017, Ballarat, Bendigo, if you bought in parts of Brisbane, if you bought in places like Orange, if you bought in places like Ballina, Lismore, like it's not like this is occurring. This is just a Sydney phenomenon, and you can see here from the national chart, it's a national phenomenon, but actually there have been markets that even in 2017-18, they went like this, right? They didn't experience this downturn at all. So the second takeaway that I want to illustrate from the second chart, is that Sydney is more pronounced, and Sydney has a very high weighting on national dwelling values. The reality is that there are always some markets that buck this trend. So once again, if you're on the sidelines, you're thinking, is this the right time to buy or not? Regardless of macroprudential regulation, there are always markets will continue to grow. Okay, that's the second takeaway. The third takeaway that I want to illustrate from this third chart right here, what this shows us is the RBA's housing credit aggregate. So month-on-month change in housing credit. Effectively, it's showing how much of this housing boom is spearheaded by owner-occupiers versus investors. And you can see that the previous boom that ended in about 2017, that one was really spearheaded. You can see here, this was investor lending. See that come right up? See how owner-occupiers, they were getting priced out of the market. That started to come down, that red line, and this investor lending, the speculative buying, that started to come up. That's really what impelled the APRA to put the brakes on. This time round, it doesn't look like that. In owner-occupier lending is increasing. Investor lending is increasing as well, but it's not like owner-occupiers are coming down. And what this is really illustrating is that, the takeaway that I take away from this is owner-occupiers are sticky. When they buy to live in there for the first time or upgrade, even if they lose their jobs or experience financial hardship, the last thing they want to do is sell their properties. Whereas investors are very quick to buy and sell because it's not their principal place of residence. It's not an emotional thing. It's not their livelihood. So for that reason, this boom I've mentioned before in different videos is more sustainable because it's led, as you can see here, predominantly by owner occupiers. There's only been 3 property booms in the last 50 years like this. This is the third one, and it's much more sustainable because it's predominantly led by owner occupiers. Real, house buying because of real circumstances, because of real outcomes, not just making money. All right, yes, investors are increasing, but they're still dwarfed by owner occupiers, which was completely different in the last boom. You could see owner occupiers came down, investors going up. In fact, the boom started because of investors. See that right here? So it was a bubble. Whereas this time the boom has started, you can see in 2019 to some extent, and in 2020, predominantly here by owner occupiers, not investors. So it's much more sustainable. So once again, if you're on the sidelines, you think that this is a bubble, the data suggests that it's not a bubble. It suggests that it's a boom, and it's not going to last forever, but it's more sustainable than not. Okay. And then the next chart that I want to go through is 3 quick charts here that will give you a lot of, a little bit of a more balanced view. So the first one is percent of loans originated with a debt to income ratio of more than 6 times. What this means is that for every loan or all the loans that have been given out by banks, the people getting those loans, how sustainable is it? Here we see a debt to income ratio measure of 6 times, which means the debt that you're taking out for your loan, that's 6 times your income. And what's concerning here is that it's rising, right? So it's rising. You can see back in 2019, only 14% of all loans had a debt to income ratio of more than 6 times. Now it's, up about 7 or 8 percentage points. So things are getting less affordable. However, to kind of counteract that, everyone who says that debt is out of control, all that stuff, check this out. Percentage of loans on interest-only terms. All right, so this was increasing, as you can see, but it's not really been increasing, abnormally. So it's not like investors are speculating, getting loans on interest only with no intention of paying it back, and if interest rates rise, they're all, doomed. It's not the case. In fact, interest-only terms were higher back in 2019 when there wasn't really a boom going on. And in fact, the latest month that this shows, June, is right back down. Right, so this suggests to us that people are getting principal and interest loans. That's more sustainable. They think they can pay that off. It makes for a more balanced view of this. Oh, debt is increasing. It's unsustainable. That whole view of the world. But tell me if you disagree in the comments. And the last one that's I think quite good is percentage of loans originated with an LVR of 90% or more. So LVR means leverage ratio. That just means that if the property was worth $100,000, have you got a loan of more than $90,000? All right, 90%. So this tells me here that what's really encouraging is in the last few quarters, this is December quarter, March quarter, June quarter, actually the average LVR has been coming down. So, some of you might say, well, how does this make sense? Prices are going up, house prices are going up, so surely LVR is going up because people are getting more and more debt as a percentage of their total purchase price. Actually, the data suggests it's not true, right? Yes, property prices going up. This suggests to me that people have a lot of money. There's a lot of money on the sidelines. They're happy and willing and able to give a bigger and bigger deposit, even to disproportionately compensate for that increase in property price. So between December, this third bar from the right, and June, property prices on average have gone up about 15% in some places, like especially Sydney and Melbourne. But the LVR's come down. So a lot of money on the sidelines, guys. So, you can't take you or me to be the average person. Just like in cryptocurrency, there are whales that affect the market. Same in property prices. A lot of people, a lot of high net worth, a lot of money on the sidelines. It's not the average person that, determines property prices. This is not like a democracy. It's, unfortunately, we live in a society where the top 5%, top 10% impact or influence property prices the more in terms of their wealth. Okay, so that's what that tells me. Tell me if you disagree. I'm really encouraging you to tell me your opinions. And last chart that I'll share is, well, what about debt? Okay, so household debt to income ratio and household debt and housing debt to income ratio. So household debt is all your debt, credit cards, personal loans, car loans, everything like that. and that is the black line. And then there's housing debt, so you're specifically more mortgages, that's your red line. And so yes, it's undeniable that since 1991 this has been consistently increasing, right? You can see here that in the GFC around 2007 it started to flatten out. We had a bit of a recession, all good, and then that debt continued to increase. You'll also notice that the gradient of increase in the last 10 years has not been as fast as in the preceding 10 years. So, people say, money printing, it's all out of control, blah, 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 blah. Well, actually, there was not much money printing in the 1990s, and you can see the gradient or the steepness of this debt curve was much more steep than in the last 10 years. You can see that it's less steep here. So once again, just trying to bust some myths. Yes, debt is high, that's undeniable, but what's really interesting here as well is that the difference, or if you subtract overall debt from household debt, the difference is kind of constant the whole time, right? And so what does that tell us? That might tell us that people are more reasonable if housing debt or mortgages go up. They've been, compensating that in their overall lifestyle. But tell me what do you think this chart tells you? Right? It's undeniable that debt has been increasing, but it has been seen to be flattening out in at least the last 1 or 2 years. Savings rates have been going up because people haven't been traveling, borders are closed, people have been able to save. It's like a record level of savings rate right now in Australia. So, it's easy to kind of say flippant statements like debt's out of control, we're in for a crash. But you can see here that in the last 10 years, it's been more shallow than the preceding 10 years. And in the last, you could say 3 years almost, 2 or 3 years, debt levels have been pretty flat. Okay, so once again, I'm just one person. There's 25 million experts in property around Australia. That's the population of Australia, including kids. I'm just one of them, guys. So I don't have all the answers, but I just thought I'd give you some data and tell me what you think this all means, right? Tell me, leave a comment below. Do you think property prices will continue to rise? If so, leave a yes below. Do you think property prices are now going to flatten out or go down? Leave a no below. Okay, a yes for continue to rise, a no for flattening out will now stop increasing. Leave a no in the comments below, guys. So if you got some value out of this, step up your learning. These are just some very elementary things. Step up your learning. Join my Facebook group. The links are below. Check out my podcast, links are below, and don't forget to answer that question whether you think prices will continue to go up, yes, or will now start going down, no. All right, thank you for being here with me. My name's PK, and remember, the most important real estate is always, always, always the 6 inches in between your 2 ears. Good luck with everything, guys. Catch ya.